Welcome to Breaking News to Trading Moves. Today we are looking squarely at the medical technology sector. We have some numbers coming out of a major player that are causing some movement in the markets. We're talking about Abbott, that's ticker ABT, and the specific reaction we're seeing across the diagnostics landscape.
It's good to be here. And yeah, this is a classic case of a headline number acting as a kind of signal for the broader market. We're going to be looking at the specific data points from Abbott's latest report and, more to the point, identifying the winners and the losers that emerge from this.
Okay, so let's get right into the headline event then. The core fact driving everything today is that Abbott has missed its quarterly revenue expectations. And when you look at a company the size of Abbott, a miss like that grabs attention immediately.
It certainly does. But, we have to be precise about where that miss actually came from. It wasn't a failure across the board.
Okay.
The weakness was highlighted specifically, and this is the important part, in Abbott's diagnostics business. That is the key variable here.
The diagnostics piece.
Got it. And the market reaction was pretty swift. It seems like the tone of the guidance coming out of that report has put some real pressure on sentiment, and not just for Abbott, but across the broader medtech and diagnostic sectors.
Exactly. It's the tone that matters so much. Investors are reading this report, and they're currently reassessing near-term testing demand. They're looking at pricing structures. They're trying to figure out, is this an Abbott-specific issue, or is the whole market for diagnostics just softer than they anticipated?
So let's break this down. Why does the market care so much about this one report? Abbott's obviously a giant, but why is this specific miss causing traders to look at the whole industry differently?
Well, it comes down to the concept of the mega-cap signal.
The mega-cap signal.
Yeah. Abbott is a mega-cap healthcare name. It's ubiquitous. When a company of that size, with that much reach into hospitals and labs, misses on something as fundamental as diagnostics, traders view it as a read-through for everyone else. A read-through. So you mean if it's happening to Abbott, it's probably happening to the smaller players too.
Precisely. It sets a baseline for expectations. If the giant in the room is seeing headwinds, it's very difficult for the smaller players to come out and claim they're immune.
That makes a lot of sense. Okay, so what are the specific factors here? You mentioned the diagnostics business was the weak point. What are investors worried about specifically?
There are, I'd say, three main factors at play. The first, and maybe the most obvious, is diagnostic testing volumes.
Volumes.
The market is looking at this miss and asking, what does this tell us about flu season strength? What does it tell us about routine lab utilization?
That makes sense. If Abbott is selling fewer tests, it implies either fewer people are getting tested or maybe that flu season just wasn't as severe as everyone had predicted.
Correct. Volume is the lifeblood of diagnostics. If the volume isn't there, the revenue isn't there. And that brings us to the second key factor, which is pricing and mix.
Pricing and mix. Okay, this is where it can get a little technical. We know that we're moving away from the COVID era peaks in testing.
We are. The COVID-related headwinds are fading, and we've known that for a while. But the nuance here, and this is critical, is that the transition is not always cleanly executed.
What do you mean by not cleanly?
It's not a straight line down and then flat. It affects the pricing dynamics. You have different types of tests, different reimbursement rates, and as that mix changes, it creates volatility in the average selling price.
So it's a bit messy. The types of tests being sold are changing, and the prices for those tests are stabilizing, but maybe not where the companies want them to be.
Exactly. And when the transition isn't clean, it creates uncertainty. And uncertainty is what investors hate most, which leads us to the third factor, and this one looks further out, guidance credibility.
Right. And we're talking about 2026 guidance. That feels like a long way off, but markets are always looking forward.
Always. And the concern here extends across the medtech and life sciences tool sectors. If a company misses a quarterly target now and cites these complex headwinds, investors start to question the credibility of those long-term 2026 targets.
They start asking, can they really hit those numbers if the current environment is this choppy?
That's the question. It casts a shadow over those long-term promises, and it forces a reevaluation of the whole growth trajectory.
Okay, so that is the setup. We have a revenue miss in diagnostics from a major player, creating questions about volume, pricing, and future credibility. But as always, when money moves out of one area, it usually moves into another. Let's talk about the winners.
There are always winners, even in a report like this. It's about understanding the second-order effects.
So the first category of winners we're looking at is reference labs and lab outsourcing. This seems a bit counterintuitive at first glance if testing volumes are down generally. Walk us through the logic here.
It is about efficiency. Imagine a scenario where hospitals and clinics are tightening their budgets. They're under a lot of pressure. They can't afford to run every single test in-house if it's not cost-effective.
So they look to outsource.
Exactly. There's a movement of routine testing toward large, efficient reference labs. These are, you could almost say, the factories of the diagnostic world. They operate at a massive scale.
And investors like that scale.
They love it. In this kind of environment, investors really favor business models that offer that scale and possess what you might call sticky provider relationships.
The relationship.
Yeah, once a hospital contracts with a large lab, that business is relatively secure, even if overall volumes fluctuate a bit. The efficiency gains protect the margin for the reference lab.
Okay, so who are the names to watch here?
Two main tickers come to mind. First, you have Quest Diagnostics, ticker DGX.
DGX.
And second, LabCorp, which is ticker LH.
So Quest Diagnostics, DGX, and LabCorp LH, these are the giants of the reference lab world.
They are. And the thesis is that as hospitals pull back on internal spending, these companies are well positioned to pick up that volume.
All right, let's move on to the second category of winners. Life sciences tools and diagnostic platforms. This is about diversified demand, is that right?
It is. This really addresses the concept of resilience. So even if near-term diagnostic volumes wobble, maybe people aren't getting as many flu tests this quarter, these diversified tools and consumables businesses can remain resilient.
Because they aren't just relying on one type of test.
Right. You can think of them as selling the picks and shovels. They sell the instruments, the reagents, the automation equipment. And here's the key nuance. Share shifts in lab workflows can still support demand for these items.
Explain that a bit more. What do you mean by share shifts in lab workflows?
Well, even if a test moves from a small hospital lab to a big reference lab, that reference lab still needs reagents. They still need automation. They probably need even more automation because of their scale.
I see.
So the demand for the underlying tools continues. It just moves to a different location.
So the demand for the tools is stickier than the demand for a specific test itself.
In many ways, yes. It's much broader and less dependent on, say, the severity of a single flu season.
So who are the tickers to watch in this space?
Here we're looking at Thermo Fisher Scientific, ticker TMO.
TMO.
And Danaher, ticker DHR.
Thermo Fisher, TMO, and Danaher, DHR. These are massive, diversified companies.
They are, and they're often seen as sort of safe harbors when the specific diagnostics market gets choppy like this.
Okay, let's look at the third category of winners. This one is about growth. We're calling this higher growth specialty diagnostics and screening.
This is the rotation trade. When investors see that routine diagnostics like your basic blood panels or flu tests are getting choppy or slowing down, they start looking for clearer secular growth.
They want something that's growing regardless of the economic cycle or, how bad the flu is.
Exactly. And the focus here moves to screening and specialty testing. Things like cancer screening are a prime example.
Why is that considered clearer growth?
Because the adoption of these kinds of tests is still in the early stages compared to routine blood work, there's a long runway of adoption ahead. And usually these are recurring test volumes.
Right.
I mean, if you're screening a population for colon cancer, for example, that's a massive, still largely untapped market compared to the flu, which varies so much year to year.
So the valuation impact here is positive for these companies.
Yes. This rotation can support the multiples for companies tied to that screening adoption. Investors are willing to pay a premium for that kind of growth visibility.
And the tickers to watch here.
I'd point to Exact Sciences, ticker EXAS.
EXAS.
And Hologic, ticker HOLX.
Hologic, HOLX. So to recap the winners, we have the big reference labs benefiting from outsourcing, the tool makers benefiting from diversification, and the specialty screening companies benefiting from the search for growth.
That's the trifecta of, let's call it, safety and opportunity in this specific market setup.
Now, of course, we have to look at the other side of the coin, the losers. The headline started with a miss, so there have to be companies feeling the pain.
Unfortunately, yes. And the first category is fairly obvious. Broad diagnostics exposure.
The logic here is just near-term volume sensitivity.
It is. The Abbott miss reinforces this idea that testing demand is softer than expected. So if you're a company whose primary revenue stream is exposed to these near-term swings in testing volumes and pricing, well, you're in the line of fire.
It's the direct hit.
It is. This specifically hits companies that don't have that massive diversification or the safety of the reference lab model to fall back on.
And obviously the primary name here is Abbott itself.
Yes, Abbott Laboratories, ticker ABT. They're the subject of the news, and they're taking the direct heat for it.
And are there others caught in this same boat?
Queel Ortho is another one to watch here, ticker QDEL. They have a great deal of exposure to these same diagnostic volume trends.
Queel Ortho, QDEL. Okay. The second category of losers is what we're calling Medtech bellwethers.
This is where we see sympathy pressure.
I always find that phrase curious. Sympathy pressure.
It's behavioral, really. Yeah. The logic is that even if the fundamentals differ between companies, even if Medtronic is doing something totally different from Abbott in many ways, a negative read-through from a large peer tightens sentiment across the entire group.
It's sort of a guilt by association effect.
To an extent, yes. Investors get nervous. They start worrying about forward guidance, procedure volumes, hospital spending priorities in general. The thinking is, if hospitals are buying fewer diagnostic tests from Abbott, maybe they're also delaying capital equipment purchases from other companies.
That's the fear.
That is the fear. And that fear compresses valuations, even for companies not directly affected.
So who are the tickers caught in this sympathy move?
Medtronic, ticker MDDT, and Johnson & Johnson, ticker JNJ.
Medtronic, MDT, and Johnson & Johnson, J&J giants, in their own right, but not immune to the sector sentiment.
No one is fully immune when the mood turns like this.
And finally, the third category of losers. Diagnostics-heavy life science names.
This logic ties back to lab spend cycles.
Okay, so we talked about the tool makers like Thermo Fisher being winners because they're so diversified. How are these different?
These are companies with a heavier diagnostics and lab exposure. So if investors start pricing in slower diagnostic demand or more cautious lab budgets, these specific companies face multiple compression.
So it's all about the concentration of risk.
Correct. If your business is heavily weighted toward the exact areas that are seeing weaker near-term expectations, the market is going to punish that multiple. They aren't going to pay as much for $1 of your earnings if they think the growth is slowing down.
And the tickers to watch here?
I would point to Revvity, ticker RVTY.
RVTY.
And BioRad Laboratories, ticker BIO.
Revvity, RVTY, and BioRad BIO.
These are excellent companies at what they do, but in this specific news cycle, their particular exposure is working against them.
So we've covered a lot of ground. We started with the Abbott miss, analyzed why the market cares about volume and pricing, and then looked at how money is rotating. It's flowing into reference labs and specialty screening while moving away from broad diagnostics and pure play exposure.
It's a complex ecosystem.
It really is. I want to circle back to something you mentioned earlier about that megacap signal. You said Abbott acts as a read-through. Can we get a little deeper into how traders actually use this information? When that news crosses the wire, is it instantaneous?
The initial reaction is almost instantaneous. Algorithms pick up the revenue miss within milliseconds.
Right.
But the human analysis, the part we're doing now, takes a little longer. Traders have to digest the why. If Abbott missed because, say, a factory burned down, that's one thing. That's an isolated event.
That's an Abbott problem.
Exactly. But because they missed on demand and pricing, that's seen as structural. That's what scares the market.
Because structural problems tend to persist.
Yeah. They do. A structural problem in diagnostics implies that the whole post-COVID landscape is still settling. We all assumed we would just go back to normal, but normal is turning out to be a moving target.
And that uncertainty is what drives the rotation into the winners we discussed. If you don't know what normal looks like for flu testing, you buy the company that does cancer screening, because that demand seems more predictable.
Precisely. You seek certainty. You seek out that secular growth that is divorced from the quarterly fluctuations of the flu season.
It's something to see how a single earnings report can trigger this whole cascade of decision-making.
It connects everything. It connects hospital budgets to lab workflows to stock valuations.
Let's spend a moment on that hospital budget aspect. We touched on it with the reference labs. If hospitals are tightening budgets, what does that actually look like on the ground?
It means they're scrutinizing every single line item. They're looking at their labor costs. Lab technicians are expensive and hard to find. They are looking at their equipment costs, their reagent costs. If they can send a test out to Quest or LabCorp for, say, $10 less than it costs them to run it in-house, they're going to do it. The math becomes very simple.
And that margin pressure on hospitals is effectively the tailwind for Quest and LabCorp.
That is the dynamic. One entity's budget crisis is another entity's growth opportunity.
And on the flip side, That budget tightening is the headwind for the equipment manufacturers if the hospital decides to delay buying a new analyzer.
That is the risk. Although, as we noted with Thermo and Danaher, there's a floor to that risk because the labs still need to function. You can't just stop buying everything. But the explosive growth might be tempered.
This has been a really comprehensive look at the fallout from the Abbott numbers. It's not just about one company. It's about the health of the entire diagnostic ecosystem.
It really highlights how interconnected these subsectors are. You really cannot look at Abbott in a vacuum.
No, absolutely not. I want to really get into the weeds of the reference lab business model because we touched on it, but I don't think we fully appreciated why this outsourcing trend is so powerful. When we talk about Quest, ticker DGX, and LabCorp LH, we call them factories, can you paint a picture of what that actually means operationally?
Absolutely. Think about a typical hospital lab. It's busy, it's probably a bit cramped, and they're running hundreds of different types of tests. They might run a cholesterol panel, then a flu test, then a thyroid check. Each of those requires different machines, different reagents, different calibration. It's inherently inefficient because they're doing a little bit of everything.
For the general store.
Exactly. A great analogy. Now picture a major reference lab hub run by Quest or LabCorp. These facilities are massive. They have automated tracks that move samples around like luggage at an airport. They might have a dedicated line that does nothing but thyroid tests, running thousands of them an hour.
So the cost per test just drops dramatically.
It plummets. They buy reagents in massive bulk at prices a single hospital could never negotiate. They optimize their labor so that one technician can oversee 5 machines instead of 1. That is the economy of scale in action.
And that's why, when a hospital CFO is staring at a budget deficit, outsourcing becomes so attractive.
It's simply cheaper to put the sample in a courier van and send it down the road.
Right, and let's talk about those courier vans for a second, because that's the moat we mentioned earlier, that stickiness.
It's a huge part of it. Quest and LabCorp have fleets of vehicles that crisscross the country every single day. They have pilots, they have planes.
They have an Air Force.
Essentially, yes, a small one. They have logistics networks that rival actual shipping companies.
Right.
If you're a hospital, you need that result back fast. You can't just put it in the mail and hope.
Of course not.
You need a dedicated courier to pick it up at 4 p.m. and have the result back in the doctor's electronic record by 8 a.m. the next day.
And building that kind of network from scratch is almost impossible for a new competitor.
It's incredibly capital intensive. That's why DGX and LH are such dominant players. It's not just about the science. It is very much about the logistics.
That makes that sticky provider relationship point much clearer. If you're integrated with their courier route and their IT system, switching is a massive headache.
It is a huge headache. And in a time of market volatility, investors love businesses where the customers are, for all intents and purposes, stuck. It provides a real level of safety.
Let's pivot back to the losers, specifically the sympathy pressure on Medtronic, MDT, and Johnson & Johnson J&J. I want to play devil's advocate here. If I'm a surgeon and I need a heart valve from Medtronic for a patient, I'm not going to cancel that surgery because the lab is outsourcing flu tests. Is the market overreacting here?
That is the perennial question. And in the short term, often, yes, the market can overreact. But the algorithm doesn't think like a surgeon. It thinks like a risk manager. And the risk manager sees hospital CapEx as a single bucket of money.
So they view the hospital as just one big wallet.
Pretty much. If the diagnostics line item in that wallet is under pressure, the assumption is that the whole wallet is shrinking. And while a heart valve is essential, maybe the hospital decides to delay upgrading their electrophysiology lab. Maybe they decide to keep their old surgical drills for another 6 months.
So it's not about the consumable implant itself, it's about the capital equipment surrounding it.
Exactly. That's the key distinction. Medtronic and J&J sell a lot of heavy equipment too. Robots, imaging systems, surgical towers, those are big ticket items. And when budgets get tight, big ticket items get delayed. That's where the sympathy pressure comes from.
That distinction between the procedure and the capital equipment is vital. The surgery happens, but the big upgrade doesn't.
Correct. And for companies that are priced for growth, a delay in those big upgrades is enough to compress the multiple.
Let's talk about QuidelOrtho, ticker QDEL. We lump them in with Abbott as having broad diagnostics exposure. Why are they so vulnerable here?
QuidelOrtho is a very good case study because they are heavily exposed to the respiratory season. They made a massive name for themselves during the pandemic with all the rapid testing.
They were the ones selling the tests you could buy at the pharmacy.
Exactly. And the market is now struggling to figure out what the baseline revenue is for them. What's the new normal? So if Abbott, who has even more data and a broader portfolio than Quidel, is saying respiratory testing is soft, then Quidel has nowhere to hide.
They're a pure play on that one area.
They're a pure play on the very thing that is currently weak. They don't have a massive pharmaceutical division or a medical device arm to cushion the blow, and pure plays get hit the hardest when their specific theme turns negative.
It really emphasizes the value of diversification, which brings us back to Thermo Fisher, ticker TMO. We called them a winner. But surely if labs are doing fewer tests overall, doesn't Thermo sell fewer reagents?
They might sell fewer reagents for flu, yes. But you have to remember, Thermo Fisher sells to pharma companies making new drugs. They sell to universities doing basic research. They sell to environmental testing labs checking water quality.
So if the flu is weak, maybe the biotech research sector is strong that quarter.
Exactly. They have so many different cylinders in the engine that if one misfires, the car keeps moving forward. That's why they command a premium valuation. Investors are willing to pay for that stability.
It's the portfolio approach within a single stock.
Precisely.
I want to touch on the guidance credibility issue for 2026 again. It just seems so far away. Why is the market so obsessed with these long-term targets?
Because stock prices are, at least in theory, the sum of all future cash flows discounted back to today. So if you lower your expectation for 2026, you aren't just lowering 1 year. You are lowering the entire trajectory of the company for the next 5 or 10 years.
You're changing the slope of the growth curve.
You're flattening the curve. And a flatter growth curve means a lower stock price today. When management gives a long-term target, they're putting their reputation on the line. If they miss a short-term target and blame macro factors, investors start to wonder if the management team actually has a handle on the business.
It introduces doubt.
And doubt is poison for valuation. Investors hate not knowing if the captain can actually steer the ship through a storm.
Okay, let's look at the secular growth winners one more time. Exact Sciences, EXAS, and Hologic, HOLX. We mentioned cancer screening. Is there a risk there? What if people stop getting screened for some reason?
There is always a risk. During the pandemic, for example, screening rates plummeted because people were afraid to go to the doctor. But that volume eventually came back. It's deferred, not lost.
Whereas a missed flu test is lost forever.
Exactly. If you have the flu in January and don't get tested, you don't go back in July to get tested for the flu you had 6 months ago. That revenue is just gone.
Right.
But if you miss your colonoscopy, you still need to get it done. The demand accumulates.
That accumulation of demand provides a backlog that investors really love.
It provides visibility. You can look at the demographics, the aging population, and model out the demand for cancer screening with much higher precision than you can ever model the next flu season.
And in a market that's scared of uncertainty, precision is king.
Precision and predictability. That is what Exact Sciences and Hologic represent in this context.
So if we were to summarize the main idea of this conversation, it was to take a single data point, Abbott's miss, and map out the blast radius.
The blast radius is a good image. We found the shelters, which are the reference labs. We found the fortified bunkers, the diversified tools companies. And we found the exposed positions, which are the pure play diagnostics.
And the lesson for you, the listener, is to not just read the headline Abbott misses, but to ask, who else does this hurt? And just as important, who does this help?
Always look for the second derivative. That is where the trading moves are often found.
Speaking of trading moves, we've identified quite a few tickers today. Let's just run through them one last time for clarity.
Sure, let's do it.
The Newsmaker, Abbott Laboratories, ticker ABT.
The source of the signal.
The winners in outsourcing, Quest Diagnostics, ticker DGX, and LabCorp, ticker LH.
The scale players.
The winners in tools, Thermo Fisher, ticker TMO, and Danaher, ticker DHR.
The diversified giants.
The winners in growth, Exact Sciences, ticker EXAS, and Hologic, ticker HOLX.
The secular growers.
The losers in sympathy, Medtronic, ticker MDT, and Johnson & Johnson, ticker JNJ.
The collateral damage.
And the losers in exposure, QuidelOrtho, QDEL, Revity, RVTY, and Biorad, ticker BIO.
The ones facing the direct headwind.
It's a comprehensive list, and it really shows that you can build a whole thesis around a single earnings release if you know where to look.
It's about seeing the relationships between the companies.
The web of the market.
The web of the market, exactly.
Before we sign off, I want to ask one final question. We talked about 2026. If you're an investor looking at this space, do you think this is a permanent reset for diagnostics, or is it just a post-COVID hangover that will eventually clear up?
That is the billion-dollar question, isn't it? My sense, looking at the data, is that it's a transition. The hangover analogy is apt. We binged on testing during the pandemic. Now we are detoxing. Eventually, we will find a healthy equilibrium. But the road to that equilibrium is bumpy, and that bumpiness is what we saw in Abbott's numbers today.
So patience is required.
Patience and selectivity. You can't just buy the whole sector blindly anymore. You have to pick your spots very carefully.
And that is exactly why we do this, to help identify those spots.
Indeed.
Well, this has been a substantial breakdown. We've gone from the headline numbers all the way to the operational weeds of courier vans and hospital budgets.
It's the only way to really understand the move.
I agree. Thank you for your analysis today. It has been illuminating.
Thank you. It's always good to get into the details.
And to our listeners, thank you for being with us. We hope this helps you navigate the noise of earnings season.
Keep your eyes on the data.
And finally, the mandatory disclaimer. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.